Moving countries can be one of the most exciting and most challenging things you'll ever do. And we're here to take one big worry off your plate: your taxes. At Expat Taxes, we understand the complexities of Irish tax from your perspective as an expat and tailor our advice to your needs. With decades of expertise, our team at Expat Taxes will help you navigate tax residency, cross-border taxation, reliefs and returns, and will work with your country's tax advisor to make sure your taxes are sorted. Whether you're an individual or a corporation coming from Australia, the United States, the UK, or anywhere in the world, we want to help you. So visit us at expattaxes.ie to book a consultation today, and let's make moving to Ireland easier together.
Welcome to Taxbytes for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Hi everyone. This episode is part 2 of Stephanie Wickham's chat with Daniel Howse, a global mobility tax expert and partner at Tax Advisory Partnership in England. In this post-Brexit, post-lockdown world, the idea of remote working across the planet is normal for companies and employees alike, and a great benefit for expats. What's often missed is cross-border taxation and planning for incentives that make it beneficial for those employees and companies. This is where Dan comes in. Last time, Dan talked about social insurance, cross-border taxation, and remote working. In this episode, he shares his experience on the UK non-domicile legislation changes, the changes to the remittance basis of tax, and what every new or returning UK expat needs to know before jumping in. If you'd like to know more about what Dan has on offer, check the show notes for his contact details. Now, let's get to the episode.
What I'd love to talk about in the context of what I see in the press and the media at the moment is, changes to the UK regime. And they're front and centre for a lot of UK clients, and particularly those who are high net worth. In Ireland, our tax legislation, particularly as it relates to the remittance basis of tax for non-domiciled individuals, is very similar, if not identical in parts, to what is now outdated and superseded UK legislation. Talk us through what's happened. Talk us through the history, the change for people listening who have no knowledge, and perhaps then the new regime that's coming on board or has come into effect already.
Yeah, sure. Yeah, so changes in 6th of April are probably the biggest change in my career, other than the statutory residence test coming in the UK. It's probably the closest that it's been to exciting in terms of rule changes. But it's so the UK is now, from 6th of April, it's done away with domicile as a concept in tax, which, without going into kind of too much long boring detail of tax history, domicile is essentially kind of where your long-term intention to reside is. And there's a lot of grey areas, and people are relying on case law rather than statute. And there are a lot of people sort of perceived to be kind of manipulating the rules for their benefit. So the UK have removed domicile, and they've also removed remittances. So prior to 6th of April, people that were non-domiciled could access the remittance basis, which essentially meant that they were only taxed on their non-UK income and gains if they actually physically remitted them to the UK. And I don't know whether it's kind of the same in Ireland with what is a remittance, but it's not kind of as simple as just moving money from A to B. It can be something that using funds to kind of buy a car in Ireland, but then using it, put it on the ferry over to the UK, and that can count as remittance. And it's quite a complicated sort of concept, especially for non-tax people to kind of get their heads around. And it kind of involved a lot of planning in terms of kind of bank account structures and people having to have different bank accounts with different type of income and gains, and being very careful about what money they moved into the UK and having to do things on a tax year by tax year basis. I mean, it was kind of good for advisors because it kind of gave us a lot of planning work, but it made it very complicated for the individuals. And kind of fundamentally, and kind of the main sort of political and economical reason why the government made the changes is it meant that it sort of discouraged non-domiciled individuals from actually bringing their money into the UK and spending it in the UK and investing it in the UK, which is kind of not what you want people living in the UK to do. You want them spending their money here and investing in UK businesses and paying VAT and all of that. So it was eventually decided, and fortunately, it was the Conservatives that kind of made the proposals, and Labour pretty much introduced them as proposed. But now remittances from 6th of April are being removed. So the new rules are sort of similar, but actually kind of more straightforward to understand. So it now purely looks at someone's residence position. So the new regime is called the foreign income and gains regime. For people that are coming to live in the UK, as long as they have been non-resident for the previous 10 UK tax years, can access this FIG regime, as we're calling it. And it's also winding it up because previously it was only non-domiciled individuals, which UK nationals were typically UK domiciled as well, so couldn't access the remittance basis, even if they were long-term non-residents. What this has done has opened it up to long-term Brits as well. So if you've got someone that has been outside the UK for more than 10 years, they can also use this, which might be a tool to kind of attract some people back to the UK that might not otherwise have done, that kind of set up a life elsewhere, have investments outside the UK. It kind of sort of means that they can access this. But what it does, it means for the first 4 years of residence, they are only taxed on their UK source income and gains. So their foreign income and gains are outside of the UK tax net, whether they remit them or not, which is really good for them because it means that if they sell kind of their overseas property, they can now bring that money to the UK if they've made a gain on it. Kind of it might have been exempt anyway under private principal relief, but we won't touch on that. But it sort of means the money that they might have otherwise kept outside the UK because they would be taxed on it, they can now freely bring to the UK. The downside to it, though, is that after the 4 years, they would then be taxed as a UK national, long-term Brit like myself, and they go onto the Horizon basis, which is worldwide income and gains with foreign tax credits. Whereas previously under the remittance basis, you could access it long-term. After 7 years, you had to start paying a charge, which is 30,000, which increased kind of the longer you accessed it. But it does mean in the short term, it's more attractive and more beneficial. But for people that are coming here on a longer term, it means that they are in theory paying kind of more tax from year 5 that they're here.
So to kind of play that out, if you've got long-term non-UK residents who are planning to return to the UK, they can essentially quite gently return to the UK. Does it mean then that the existing non-doms leave? Can they reset? They need to be outside of the UK for 10 years to come back in under FIG?
They do, yeah. So there's some transitional rules in place. So people that are kind of non-domicile, they essentially kind of still qualify for effectively 4 years. So if you've had someone that was claiming, well, sort of non-domicile claiming being here 2 years, they qualify for the FIG regime for the next 2. But yeah, for non-domicile people that are resident, and same for UK people as well, would have to leave for 10 years to benefit, on the way back in. Yeah, it's interesting because it has massively simplified it, which is great, but it's the kind of long-term attractiveness to kind of previous non-domiciled individuals. It probably makes the UK a less attractive place to come to long-term. But yeah, certainly for people that kind of want to spend a few years in the UK, that kind of have assets outside the UK, or either sort of travel quite extensively for work, because as part of the foreign income and gains regime, they also qualify for a tax relief called overseas workday relief, which means that any non-UK workdays are treated as non-UK source income and therefore not taxable in the UK, which is kind of great for people to move to the UK but sort of travel quite extensively as part of work, or travel back to, if they've still got family in their home country and want to work back there. Or, as I've kind of been having conversations with, some people can also take a working holiday and that count as overseas workdays. Previously, overseas workdays, you had to be paid into a non-UK bank account, because otherwise if they were on a UK payroll paid into a UK bank account, it's automatically remitted, therefore taxable. Whereas now you can have an individual that's on a UK contract, UK payroll, paid into a UK bank account, but because the remittances are now no longer a concept, you just purely look at where they're working.
So therefore, that income could be spent in the UK, enjoyed in the UK without any UK tax consequences.
Yeah, exactly. It can be. So I've sort of been having conversations with some people being, okay, you can either, like, if you're going back to sort of see your family, you can have like a tag on an extra week and work there. Obviously, you've got the rules in the country where they're working, and they might potentially be subject to tax there, especially if it's their home country that they've not left. They might still want to tax those work days. It might be at a lower rate, but they might still be taxed. But just purely from a UK perspective, I mean, quite often have a lot of conversations with kind of US people that have never been to Europe before, but get seconded to the UK and kind of want to spend a lot of their time traveling around Europe, because for them, a lot of Europe's on their doorstep. So I say, well, if you have long weekends and work a Friday or a Monday in that country, that is a non-UK work day, and you can get tax relief on it. And if you're a 40 or 45% taxpayer, I mean, that can pay for some of the trip, which yeah, it feels like a bit of it's this bit sort of a strange conversation to be having with some clients, but unless I've completely wildly misinterpreted the rules myself.
Of course, yeah. And it kind of, I suppose, it supports the argument for, being able to demonstrate that. So perhaps, retaining good records, being able to show where you were. And in terms of a UK workday as defined, is that any part of a workday? Is that how HMRC define it?
So a work day for UK tax purposes is any day that is spent working at least 3 hours. And I've not seen this tested, but in theory, it's 3 hours of work. And the definition of work is very wide ranging. So it can be, if you're sat on your laptop in a departure lounge, checking your emails or sending emails, that's still work. It's not, you don't have to be sat at your desk or in an office kind of working. It can be, so as a rule of thumb, if you're being conservative, I'd say, look, if you're working part of the day, just count that as a work day.
And, we find that as well. A lot of the time, these definitions predate remote work, they predate the pandemic, they predate the internet and the digital age that we live in, which really means that most of us probably work, all day, every day, even weekends, because we check our emails.
Yeah.
So, it kind of this warped sense of, what we define as kind of a set workday versus what people live and actually what happens. There's a bit of a disconnect there, isn't it? It's hard.
Yeah, exactly. Yeah. I had an old boss that always used to say to me, oh, if you're thinking about the client, that still counts as work. You can bill them for it.
We all work long hours then, consistently.
Yeah, exactly.
Yeah. So do you see the FIG regime being as attractive as the remittance basis of tax was?
Definitely not in the longer term, no. There's been quite a lot of, it's hard to kind of know how trustworthy the figures are and what to believe, and kind of everyone obviously puts their own sort of spin on it, has their own agenda. But there's been quite a lot in the UK press about a certain number of non-doms that have already left the UK because of especially kind of the high net worth ones, or that have been here longer term. And there's also a lot, I'm not an inheritance tax expert, but there's also kind of knock-on effects for inheritance tax as well that have meant kind of longer term non-domiciles are either leaving or have left, or are kind of making provisions just to make sure that they're not caught. So I think for longer term people, it's not as attractive because they're essentially taxed as a UK domicile person from, well, year 5, whereas previously it could be up to sort of like 15 odd years. But certainly in the short term, a lot of the people that I deal with, like my client base, does tend to be kind of the people that are coming here for work purposes for a shorter period of time, or are working cross border, and they're not really intending to sort of settle here for too long anyway. So for those people, it's a lot more attractive. It's a lot simpler. There's not as much admin in terms of having to structure your bank accounts in a certain way, or keep as many records, or be careful about what money you're moving into the UK or not. And especially overseas workday relief, kind of a bit more accessible as well. I think that's certainly more beneficial.
And I think what we've seen or alluded to is, firstly, the Irish remittance basis still exists and is in, it's in its original guise. We don't have the same deemed domicile rules that you alluded to, where after a period of time there's an automatic tax charge. So Ireland's still in a very attractive place. Arguably, it is not the UK. So, whether there's an exodus of those high net worth individuals to Ireland will remain to be seen. I tend to think they're more likely to go South Europe to Italy or one of these.
Yeah, we've seen Milan seems to be quite a popular destination, because I think Italy have quite a favourable inbound regime.
They seem to, yeah.
Yeah, I think Milan's got quite a financial district as well. So I think especially a lot of people who work in private equity seem to be going there.
Yeah. But from the perspective, I suppose, of the way the Irish UK double tax agreement works, the Irish regime and the new UK regime, it would appear that with planning there are opportunities now, that if someone's under the fake regime for 4 years and they're leaving the Irish tax net for whatever reason, that, for anyone planning to leave Ireland and go to the UK, or arguably somebody who's leaving the UK and wants to understand, where they sit from an inheritance perspective on future assets. We've noticed, without being in any way expert on UK rules, that this has been a shake-up of previously held kind of assumptions that we need to kind of revisit and kind of go, right, what does this look like? Clients would do well to kind of reframe their plans potentially through these changes. I think that's one of the takeaways I'm getting from what you're saying.
Yeah, exactly. Yeah, I think it's that just making sure that it's that certainty, isn't it, of the future plans, because obviously everyone's situation is slightly different, and especially when you're looking at double tax treaties as well, there can be sort of a lot of subjectivity that goes into some of the tests as well. So I think speaking to someone like ourselves that can kind of guide you through, and I mean, the future has a lot of uncertainties as well, doesn't it? You can have all these best laid plans and something might change in your personal life. A new government might come in that change things fundamentally, and you think you might have all your ducks in a row, and that can completely go out the window. But I think having that certainty, I think this has certainly opened up new opportunities. And I think from a UK perspective, we're certainly seeing a lot more people that might not have thought of leaving the UK and now giving it active consideration and doing a bit more planning, especially around that inheritance tax piece as well.
So much to take away from this, and what strikes me is that people listening to this hopefully will find something that's applicable to their situation. When people have questions, Dan, how should they reach out to contact you and your team?
So our website is www.taxadvisorypartnership.com, or if you just search Tax Advisory Partnership on Google, then we'll come up in the results. Will you share my contact details?
We will indeed, but it might be if you want to drop them in. So your email is?
So it's dan.howse, HOWSE, at taxadvisorypartnership.com.
Perfect.
So yeah, do contact me with anything, whether it's a personal query, or if you're an employer listening to this as well, that as employees that are working cross border, then yeah, please do get in touch.
Yeah. And I think what I've been trying to get better at is explaining to clients the value of good advice. Sometimes we think about all the things that can go wrong. And, as advisors, we tend to kind of warn people, as we have in this session, of, the pitfalls.
Mm-hmm.
But the reality is that when you're working in a scenario where you're moving cross border, there's opportunities as well. And, a good advisor will help you avoid the pitfalls and find the opportunities.
Oh yeah, I couldn't have put it any better myself. Yeah, exactly. I always say to my clients, it is far better to be proactive rather than reactive. Yeah, whether it's sort of stopping yourself getting a large tax bill with interest and penalties down the line, or especially if you've got someone moving, a lot of the favourable kind of expat regimes are time limited, and you have to make an application within especially if you move into somewhere like Spain. And I think the new regime in Italy is similar, where you have to make an application for it within a certain amount of time of moving there. And yeah, getting that good advice and paying some people might think, oh, that's a lot of money to spend up front on something, but it can be an investment. That's what I sort of say to clients. Think of it as an investment in potentially saving you money down the line, or at least giving you clarity over what your position is and peace of mind.
I totally hear what you're saying there. The way I think of it these days is, from an Irish perspective, if you earn €1,000 and you're in a higher rate of tax, revenue will, without question, take €520 of that from you. So you only need to save €1,000 for one conversation with a tax advisor to have paid for itself.
Exactly. Yeah.
And most decent tax advisors will save you multiples of that in one conversation. So I think the metrics and the way that we communicate what we do and the value that we bring, and I suppose there's an implicit value in certainty, in the ability to plan, in the ability to kind of rest assured that as an employer, you're compliant, or as an employee, you're taking advantage of all relief. Those are sometimes harder metrics to measure. I don't think we do a good enough job sometimes of explaining the role that we play in this complex world of international tax.
Yeah, exactly, yeah. And also, like, when you got cross-border, you've got two tax authorities who want to maximise their own revenue, so they're going to do whatever they can to argue their own position. So it needs people like ourselves to give someone, okay, what might the authorities' approach be? What does the legislation or what does case study say, and how to help manage that? And yeah, it's complicated enough. I mean, we've been doing this for, well, I dread to think how many combined years, but
too many.
But every situation has its own slight nuances or slightly different fact pattern, which can change everything. And like I said before, there's so much subjectivity still.
Definitely.
With a lot of the rules, that it needs someone that can kind of understand that, which is kind of why, well, AI is a subject for a different day, but why it's frightening in some circumstances. But understanding that complexity and nuance is, yeah, if AI can understand that, I'll be extremely impressed.
Yeah, I could pretty much say no, it doesn't, but it's my personal view. Thank you so much, Dan. I've really enjoyed our chat.
It's been a pleasure.
And I think we've covered some really good topics. And actually, I found it really informative, just kind of going over some of the things that we come across and, we don't advise on, but we partner with advisors like yourself to support clients on. So thank you. So reach out to Dan, and his email will be in the show notes. And if you'd like to hear us chat again, feel free to drop us a note and let us know future topics that we might talk about, because we'd love to have you back, Dan, and we really appreciate your time. So have a great day.
Thank you. You too.
Thanks for listening to Taxbytes for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.